Hey everybody, I'm back! I am back! I was away for a couple of days checking out colleges with my daughter out in California. So I am back. Today is Friday, July 19th. What's going on? So, over the last few days we had a little bit of a pullback in the stock market. That was something that I had forecast. Remember, we are in this period of reserve build, and that creates some headwinds for the markets. I won't go through it again because I've been through it many times, but we are kind of treading water here. And in fact, I have to say, the market's resilience, its ability to hold up at these levels, let's say around S&P 3000, that is a sign of underlying strength. So when we get back to the window where the technical monetary condition becomes positive, and I've been talking about that. My last video I made, I said we are coming into what could potentially be a very bullish period for a number of reasons. You've got the Fed rate cut, which is coming at the end of this month. You have those positive monetary conditions that I have been mentioning. And you have the last 2 months of the fiscal year, August and September, which are huge from a spending standpoint. All right, we still have to get through the debt ceiling. That has a deadline actually of July 26th because Congress goes on an extended vacation through the month of August. They don't come back until September 9th. And Mnuchin, Treasury Secretary Mnuchin, said that around the first week in September, he's going to have a problem. Treasury's going to have a problem meeting its payments. Right now, they've been using extraordinary measures since we hit the debt ceiling back in March. It's carried, everything through relatively normal. But as of the first week in September, and he alerted Nancy Pelosi to that. So, the whole thing obviously is tied up in politics. The Democrats want an increase in discretionary spending. If they don't get that, then automatic spending cuts hit, and that the Republicans are against that because that's going to take money away from the military budget. The whole thing is a mess. Let's just put it that way. And the debt ceiling, which is a self-imposed artificial constraint, which is an anachronism. It dates back to the days of the gold standard. We got to get rid of that. Hopefully they get rid of that, but I doubt it because so many of these guys, people, and the public in general is of the belief that we're out of money, that the government borrows its money. And I've done many videos on this, so I'm not going to get into it again. But we are coming into that period, early August, and then August, September, rate cut, all that stuff really could be the perfect storm in a bullish way if everything comes together as I believe it will. And the fact that the market is holding up relatively well in this reserve building period, that is a good sign. I want to talk about oil. The EIA report that came out on Wednesday. I was traveling that day, but I did send out an email to my subscribers that had a lot of weak data in there. We saw another drawdown in crude, but we had a big increase in gasoline inventories. We had a huge increase in distillate inventories. We saw a big drop in gasoline demand. Distillate demand was weak. Refiner inputs, which is the demand by refiners for crude oil, that fell. Exports fell. The thing looked terrible, and not surprisingly, it triggered off some heavy selling by the zombies. Now, I have to say this, and I put out my report. I think a lot of that data was skewed or distorted by the hurricane. We had that Hurricane Barry, remember, right in the reporting period for that EIA. A lot of refining capacity and production was shut down. You had people hunkering down in the region that was affected. That affected gasoline demand. So what I'm saying is I think that is a temporary distortion in the data, and this pullback is probably a pullback to buy. Let me talk about gold. I've been long gold for 3 years. I've mentioned this numerous times. I have people mocking me about the gold position and my continuous purchases of gold as the price came down. A lot of you people out there, maybe some of you anyway, who thought you were so smart, saying, ah ha ha, look at your gold position. When gold traded down to 1200, even into the 1100s. All right, it's an original position that I put on in August of 2016 and had been building it as the price came down. Now I have people who have been with me who followed my recommendations and have amassed a very significant gold position, and not only that, had the mental toughness to stick with it. Now I had people, and I talked about one guy who was this tough guy. I always talked about how tough he was, working out, all muscled up, saying he was so tough, he's a trader, he's been through everything. Guy bailed out a long time ago. Sent me an email. By the way, owes me money. Sent me an email. Oh, thanks to you, Mike, I held on to my gold. But where did he get out? He got out at 1300. The interesting thing about the market right now is you have a lot of newcomers into the gold market, and we are seeing for the first time producers heavily selling into this market. Now, producers had been net buyers for the last 2 years straight. If you look at the ratio of their short to long position, and remember the producers are almost always short because they forward hedge, that had been narrowing and narrowing and narrowing. In other words, they're bringing in their short, they were covering their shorts, they were adding to long positions, their net short position was getting smaller and smaller and smaller. The entire time over the last 2 years when gold was sort of languishing and coming down. Now it shoots up to 1440. They have been heavy sellers into this rally. So while the longer term outlook may be bullish based on gold's own fundamentals, and I've spoken about this. This is the very low levels of investment into mining that we have. Gold is not like what we see in the oil industry and the energy industry with the fracking and the technology that has gone into, and look at the result. There has been an explosion in domestic production of oil precisely because of the investment that the industry has put in. You have not seen that at all. In fact, there has been a contraction in the level of capital investment into mining. So we're going to be stuck with, or I should say, the industry, the world will be stuck with actually some very tight numbers when it comes to gold supply. Really no new mine supply to speak of. And a lot of accumulation by central banks. So the longer term outlook looks pretty good. But right now on this run up, we're taking profits. And I've always said, when everybody is selling, you find us on the buy side. When everybody is buying, you'll find us cha-ching, cha-ching, cashing out and taking profits. All right, so that about sums it up. A lot of action towards the end of this month, obviously, with the Fed meeting. Yesterday, Powell, Clarita, Vice Chairman, sort of hinted at maybe 50 basis point cut. I don't think that's going to happen, but that got the market juiced up. Things have kind of settled down since those comments yesterday. But end of the month, beginning of August and September, big things, big things. Got to become a subscriber to MMT Trader. Go to my website, pitbulleconomics.com. Remember, I am the only one who has an applied approach to MMT. I have subscribers who made a fortune building a position in gold. We rode a lot of these trends. The stock market, very positive on the fiscal flows. I've been talking about that. And these reserve flows, how we're able to pinpoint these cycles, these tops and these bottoms based on these billions, tens of billions, hundreds of billions flowing into the market, into the economy, and coming back out. These absolutely tradable movements of money, enormous amounts of money that nobody really follows, nobody really understands. That's a unique part of what I do. MMT Trader, pitbulleconomics.com. Go there, sign up for a 30-day free trial. Have a great weekend. Bye-bye.